Hey guys, Jed Bratt here with the Real Estate Jedi of Big Block Realty. In this video, we're going to do another quick real estate market update for San Diego County. And we're going to talk about some, just to quickly touch up as to where we are right now, what's happening in the market, and what you kind of can expect going forward in the next few weeks and months. And also, just FYI, at the end of this month, I'm going to be going to an event we always go to every time it's available. A renowned California real estate economist of sorts really dives deep and does an extensive presentation on the current state of a lot of things, but primarily factors that influence California real estate. He dives deep in on national indicators, local indicators, just lots of things that are going to in any way influence the market, and also really studying past cycles of real estate. So after that, you can expect an excellent recap and a lot of valuable information. So look for that probably end of January, early February. But in the meantime, let's go ahead and get started with your quick beginning of 2019 market update. So let's go ahead and start with active listings again. And active listings is the inventory, as we've always discussed. Again, this is San Diego County, detached single family, condos, townhomes, twin homes, etc., all residential. We're up 39.8% at the end of December. That's just about 40% increase year over year, which is very substantial. The sold listings, we were at about 20% lower than we were year over year. So again, less properties coming off the market. Now, new listings, though, wasn't incredibly high, just over 2%, just about 2% year over year. And I think, probably a lot of sellers are being advised that, well, the market's been slowing down, a lot of inventory has been picking up, and, why throw your property on the market and compete with all this other inventory at a technically slow season anyway. So, that wasn't incredibly high, but still nonetheless, more listings coming on the market, less listings going off, and more properties sitting on the market from previously. And pending sales, which kind of predicts what we can expect to see next month, is, down just under 9%. So again, less properties still going, under contract. And that, but now what we don't see on here is that in the beginning of January, and as I'm recording this, it's January 18th, there has been a significant uptick in buyer activity. A lot more buyers are getting out of the woodwork and going and checking out properties and putting in offers. In fact, we're seeing a lot of multiple counter offers right now on properties that up until a couple weeks ago were maybe expired a few times or even sitting in the market for the last 30, 40 days. So we're definitely seeing buyers come out of the woodwork. And why is that? Well, let me show you. I think very much due in part to decreases in interest rates. So we're actually right now we're at about all-time lows for the past, going back to April. Not all-time lows, but we're at lows we've not seen since April of 2018. And what's kind of counterintuitive about this is, you might recall in December, we were talking about rate increases from the Fed. Oh, the Fed voted to raise their rates. And that, in fact, they did. In fact, in December, they voted again to increase the Federal Reserve, the Fed funds target from 2.25 or from 2% to 2.25 to 2.25 to 2.5%. So they raised it 25 basis points or 1/4%. And that's their target. And basically how this works, and I've talked about this before, but the Fed doesn't set interest rates per se. What they do is they control the amount of money that's available for banks to lend. So if there's a lot of demand for banks in giving out loans, then eventually they're going to run out of the funds they have in their system, and they're going to say, "Hey, Mr. Fed," or actually, they're first going to go to other banks. They're going to say, "Hey, do you have some money I can borrow? Because I got a lot of loans and I don't have enough money." And if that's not available, if there's not enough available money in the market, they're going to go to the Fed. And the Fed is going to control that supply of money. And by doing so, if they raise the rates on the cost of money being borrowed from the Fed, then that's effectively going to end up trickling down to the mortgage market. Now, on the other hand, if the demand for funds and money is less, if the demand goes down proportionately or less than the amount of the decrease in the Fed supply per se, that they're trying to decrease so that they increase rates, well, then of course there is a chance that you could actually see a decrease in rates. And a A lot of people don't really understand why rates go up and down, but that's ultimately what it is. It's supply and demand. It's just like real estate. If there's more supply than there is demand, prices fall. If there's more demand than there is supply, prices rise. And that's how the Fed tries controlling interest rates. But again, if demand goes down more so for funds, then the supply goes down, then there's a chance we can see a dropping off like we have here. Now, inevitably, not inevitably, part of the reason for this, though, you might wonder, why is there a dropping off in this? Well, we have a lot of uncertainty in the market, not just locally, but also internationally. Think about this. I think Brexit just fell apart the other day. But up until then, that was a very significant concern. Maybe not for you as a California home buyer or seller, but in major investors' eyes across the country and nation. Internationally. What's going on with Brexit? Are they pulling out of the EU? Well, I think that fell apart again, but that's a reason for uncertainty. Another thing, we are still going on in the longest government shutdown in our nation's history so far. Is that eventually going to get resolved? Yes, of course. But in the meantime, there's a lot of people actually not getting paid. There's uncertainty as where that's going to lead. How long is it going to last? Again, uncertainty as far as how's that going to impact the market. Additionally, you have volatile stocks, which is due to the above, and slowing global markets in general. There's a lot of numbers coming out from big countries that their growth is slowing a little bit, not necessarily losing, shrinking, but they're losing momentum in their growth. So these are all reasons that borrowers and investors might have reason to kind of hold off in the demand for asking for money. And that's exactly why we can see possibly interest rates coming down despite the Fed trying to raise them effectively. And so what I think is going to happen eventually, whenever this calms down, not this, but but I think this is going to start trending upward and follow the typical curve of the effective funds rate curve whenever there's a bit more certainty in the market. And I think that whoever tells you they have a crystal ball and they know what's going to happen this year or that, whatever, I think the truth of the matter is there's a lot of uncertainty. And I could say that I think this is just going to all flatten out pretty soon, all the turmoil, and we're just going to get back to a more boring market. But if anything crazy, unprecedented happens, then I can't really say which way this will continue. But in the meantime, that's kind of what's going on right now. So I think a lot of buyers are jumping on that. They're seeing an opportunity. They're saying, hey, there's more inventory right now than there was 12 months ago, and like 40-50% more so in some cases. And interest rates are almost lower than they were 12 months ago as well, or almost as low. So they are really winning on both ends. If you're planning on buying something this year and you want to get into a scenario where you can, per se, kick the door down and negotiate really hard and get your preferred interest rate, relatively speaking, 4.45% is still a great rate overall. Then right now might be your time to go out and take a look. Because as soon as things calm down in the bigger markets, you cannot expect that rates are going to be dropping as the Fed's raising rates. So just understand that. And I will have another update for you, like I said, end of this month or early February. Keep an eye out for that because I'm going to have a lot more information in there and a lot more juicy insight into where things likely are headed in the coming months and years. So I hope this was helpful. If you felt it valuable, please share it. And until next time, I hope you have a fantastic next few weeks. Talk to you then. Bye.